All right. Good morning to everybody. Good afternoon if you're on the East Coast. Good morning if you're on the West Coast. Hope everybody's doing great. We have a lot of people registered and on this workshop right now. I know this is a pretty big topic, especially with everything going on in the Fed world right now. This is one of my favorite topics to teach on is the Roth versus traditional TSP. We're going to take a deep dive today into some of the ins and outs of both of those, how you can utilize both of them, what are the advantages and disadvantages, and then I'm also going to talk a little bit of strategy on how you can use a lot of this to your benefit, whether you're during your working years, getting ready to retire, retiring, right, at the end of the year if you've taken the early retirement options. And so there's a wide range of people that are on this call. They're in all different parts of their career. And so what we're going to do is go through each one of these. I'm going to explain how each one works and really explain how you would make an educated decision on which one works best for you, your situation, your family as we go. For those of you that have not attended a MyFed University webinar in the past, welcome. We do these quite often, and we pick a lot of topics based on what you, the federal employee, have asked for, are looking for information on. And if you've ever been on one of ours before, welcome back. Thanks for joining. And you know that we really focus on simplifying all of the different topics that we teach on. And this is one of those ones that could get complicated. We can really get in the weeds, but we're going to keep things pretty surface level today because we want to make sure that once again, as you leave this workshop today, number one, you have an opportunity to get your questions answered. That's always important. Some of you are coming in with a lot of questions, I'm sure. And you'll probably leave with some more questions after I do this. And obviously, because we have, thousands of people on this call where we will not have the opportunity to take questions. However, at the very end of this workshop, you're going to have the ability to ask your specific questions. And so what I highly recommend is as we go through this workshop today, make sure you take really good notes, write down your specific questions, because at the very end of the workshop, you're going to have the opportunity to fill out a form and ask your questions, and somebody from the MyFed University team will get back to you to answer your personal questions. So you will get your questions answered. It just won't be live because way too many people for the sake of time. However, you will have the opportunity to get your questions answered. So again, once again, thanks for being on here. My name is Ryan Palomini. I've had the privilege now of teaching these workshops for over a decade, literally not just virtually like we are right now, but all over the country, from Maine all the way to California. And it's a privilege that I have to be able to teach these workshops. We teach a lot of them on basis. So if you work at a VA hospital, we've taught at a lot of VA hospitals. We've taught for NASA and several other agencies. So if you are part of an agency and looking to have trainers come on to your base or come on to where you guys work, feel free to reach out. We do this all over the country, and we do go on site to give these workshops. We give them, anywhere from these hour-long workshops here to full-day workshops on site. So feel free to reach out if you're on HR or if you're an employee association listening here. We're more than happy to help out. So again, thanks for being on today. Now, couple disclaimers as we go through. I work for a company called MyFed University. I'm a network representative of MyFed University, and really what that means is I've been vetted through the process to be able to not only teach on this, but also talk about the financial side of things. And that's what we're going to do. We're going to kind of take Fed and financial and kind of bring them together today in a simplistic way. So again, I'm not a CPA. I have two of them that work for me. However, we're going to talk a lot about taxes today because taxes are the foundation of every financial decision that you make, especially around this topic of Roth versus traditional. What this topic comes down to is how taxes work in your favor or how they work against you as you make these decisions on kind of deciding, am I going to go Roth? Am I going to go traditional? And so we're going to give a lot of general information today. But what I need you to do is make sure that before you make any decisions, speak to a professional, whether it's someone from our team at MyFit University that are all licensed and vetted professionals that can help, or if you work with somebody, please go back and ask them. But before you make decisions, make sure you speak to somebody first. Now, MyFed University, if you're new to the MyFed University system here, we are a national education company that is a government registered entity, which means simply put that they have the ability to bid on government contracts, that they teach all over the country for all different agencies. But if you have not had an opportunity to go to the myfeduniversity.com website, I highly recommend it. Go there, subscribe. An incredible amount of information, and actually a lot of these workshops that are done on a lot of different topics are on the backside of it. So if you go there, you subscribe, you'll get access to hours and hours of information that I think would be really helpful for everybody. Now, there's free financial planning tools, up-to-date TSP information, so a wealth of information to be able to help you make your decisions as you go through this journey of, retirement and the federal system. The other thing is for everybody that attends these workshops, whether we do it virtually, whether we do them live, every single one of you are going to have the opportunity to get what's called a benefit analysis ran for you. And what does that entail? That entails understanding your numbers, getting your personal numbers ran, so you know when you get ready to retire, if you're thinking about retiring, what are your options when it comes to what my pension is going to be, when should I take it. What I really like about this report is it not only shows you if you're going to retire next year, but it gives you a 5-year delayed retirement time as well. So you can really make those decisions, because when we work with a lot of federal employees, they're kind of in that process of, do I retire now? What happens if I wait a couple years? What's the difference? And everything comes down to making financial decisions based on your personal numbers. And so everybody attending at the very end of this workshop, once again, you will have the ability to be able to fill out that form, request this report, and we'll make sure that we get it ran for you, your personal numbers, as well as any specific questions that you have. Now, here's the agenda. We're going to go through a lot today. And again, this is going to be a lot of tax planning, a lot of tax talk, but we're going to keep it simple, because I know for some people, I can go right over your head very quickly, but we want to try to keep things simple today so that leaving here, you know how to make some decisions for yourself, okay? Now, so we're going to talk about the new 2025 tax tables, what's changed, how much space do we have, where do I fall, all those things. Review taxable incomes in retirement, because here's the thing, making a decision Roth versus traditional actually greatly affects all of your other income sources in retirement. I'm going to talk a lot about that as we go. We're going to talk about the TSP advantages, some of the changes that have happened, some of the changes that are coming in regard to this Roth versus traditional topic. We're going to talk about what traditional is, what Roth is, and how does catch-up play a role in all this. And lastly, we're going to talk on probably the number one strategy that we utilize when we work with federal employees in all 50 states, and that's this thing called a Roth conversion. We're going to look at Roth calculations, how to make those decisions. But here's what I can tell you. Working now with federal employees for over 15 years, I've had the privilege of working with a lot of high net worth individuals. And probably the most important strategy for the majority of you that are on here that are getting ready to retire, if you're with it about 5 years, is really understanding what a Roth conversion is and how it can help you in your retirement years. And I'm going to touch a lot upon that, because for most of you, truthfully, because you have this three-legged stool of retirement, right? You become a FERS or SERS annuitant when you retire. You have Social Security, and then you have this TSP. So you kind of have an edge, when it comes to finances, because you have two fixed incomes. TSP, for most people, yeah, you need it, but for most people, it's more of a bonus. And that bonus can become a very big taxable bonus if we don't pay attention to it. So we're going to talk a lot about that as we go. Okay, so let's talk about the new 2025 tax brackets. These changed. They gave us a little bit more space between each bracket, and so there are two things you got to know when it comes to taxes and tax planning. There are two things you have to understand about the tax brackets you see here. What's in front of you and on your screen are what are called the marginal tax brackets. And the marginal is basically where you fall. So for an example, most of you listening, whether you're married filing jointly, which is that middle column, or you're single or how head of household, or married file single, you're going to fall to that left tax bracket, the single taxable income. And so most of you are going to fall in that 22% tax bracket, which basically means if you're married filing jointly, your marginal tax bracket, which is the highest tax bracket that you pay tax on, it is anywhere between 96,000, 951, and you have all the way up to 206,700, right? So if you and your spouse's income are somewhere in between there, you're going to have you're going to fall in the 22% tax bracket. And obviously, as you can see, it goes up to 24, 32, 35, and the highest being 37. Now, those are called marginal tax brackets because you have a little bit, you pay a little bit of tax in each one of those tax brackets. So here's an example. A misconception about tax planning is if I am in the 22% tax bracket, then I'm paying 22% on my income. And that's just not true. What you're actually paying on, and this is really important to understand, and if you're taking notes, I'd probably write this one down. What you're actually paying taxes on is what's called your effective tax rate. And the effective tax rate is kind of just think about this. If you were to take the 10, the 12, and the 22% tax bracket, and you kind of average them together, even though you're in the 22% tax bracket, after those averages, you may pay actually about 16% in federal taxes. So you're not paying full 22, but it's the average, and that's called your effective tax rate. And the reason that I bring that up is because there's a very big misconception for a lot of people that says, hey, you know what, look, if I go from a 22 to a 24% tax bracket, no big deal. It's 2% more in taxes. I don't want to pay it, but it's no big deal. And it's actually not true because yes, you're going to go from a 22 to a 24. However, when you're making this Roth versus traditional decision, if you go from a 22 to a 24 and you go pretty far into the 24% tax bracket, after averaging all that up, that effective tax rate may be 4 or 5% more, which is more than 2. So again, big things to consider. Again, I'm not going to dive too deep, so I'm going to try to keep it surface level. But as you make these tax decisions, these are things you want to work off of. Because I'm going to say this again, you'll hear me say it a lot, taxes are the foundation of every financial plan. Every financial decision you make has got to be built on the foundation of taxes. And having somebody working with you that has a deep understanding of tax planning is so important, especially as you get ready to retire, because where we see a lot of mistakes made are right here. It's the underestimating how much tax we're going to pay. And, Uncle Sam is your partner in retirement. They're going to take it from everywhere they can get it, right? So let's avoid it as much as possible in a legal way, of course. So what's taxable? This is so important because how you make a decision on Roth versus traditional affects everything in your financial life. And again, remember, you as a federal employee, you have a 3-bucket system, and that's what this is right here, right? You're going to have your pension from the government, which, by the way, you are referred to when you retire as a FERS annuitant or a SERS annuitant. So I need you to kind of get with that lingo because people really get thrown off on that. You are referred to as an annuitant, not a FERS pension holder, not a pension person, a FERS or SERS annuitant. And why are you called an annuitant? Because you are receiving an annuity payment from the government forever. Because what's an annuity? It's an exchange. You exchange 0.8 of your paycheck your entire working career for a pension for the rest of your life. That was an exchange you made. Now, an annuity can work through that, or an annuity could just be a private exchange where you take a lump sum of money, exchange it with a financial company, and they give you an income forever. That's why you're referred to as an annuitant. So kind of get with that lingo because I see a lot of people confused by that. Then you have Social Security, right? And Social Security is one of those other fixed incomes. And here's the thing about these two is everything here that you see on your screen has got to work in harmony with each other because the amount of money you make from your annuity from the government affects your Social Security. The amount of money you make from your Social Security and your pension can affect how much you pay in tax on your TSP. Oh, and by the way, what you take out of TSP distribution can greatly affect your Social Security, tax on your Social Security, and tax on your annuity, right? So all 3 of these things play a big role when it comes to tax planning. And that's why this topic of Roth versus traditional is so important, because let me give you an example of what's taxable. So your pension or your annuity from the government is going to be taxed at ordinary income tax. So whatever tax bracket you fall into is what's going to be taxable at that point. Your Social Security, and again, this is not a Social Security workshop, but there's a lot that goes into it, but your Social Security is either taxed 0%, 50%, or up to 85% of your Social Security could be a taxable income on your tax return the following year. And what determines that on Social Security is the amount of income, taxable income, you take from your annuity and from your traditional TSP. So your traditional TSP, your pre-tax TSP, every single penny that you take from that traditional TSP counts towards your ordinary income tax, which affects how much your Social Security becomes taxable. And again, I'm telling you all these things because a Roth TSP, the distributions from a Roth TSP, which are tax-free, do not affect your Social Security. They do not affect how much tax you pay on your annuity. So remember what I said, all these things have to work in harmony with each other. And that's why it's so important that as you begin to go down this journey of, figuring out your finances, figuring out what direction you want to go in, it is understanding how all these things work in harmony with each other. Because if you don't factor in, hey, by the way, my Social Security is going to be taxable, and you don't factor that in, what if that was not a factor and that was the difference between you going from a 12 to a 22% tax bracket because you didn't understand the tax on Social Security? Right? I see it all the time. I do this now for 15 years, and taxes are the silent killer of people's retirement in so many different ways. But this is why I want to make sure I hit on this, on what's taxable, so you understand what to work off of, so that you know exactly how to start making these decisions properly. Okay. Now, we have this three bucket strategy that we talk about, and I'm not going to dive too deep in this, but I want you to think about this today as we go down this journey of, you know, where am I going to pull money from? I've got all this money in TSP. Where's it going to go? How do I distribute it? And I got to tell you, a lot of these decisions are based on how much Roth TSP you have versus how much traditional TSP you have. Because if you look at this three bucket strategy, this is all based on the foundation of taxes, right? Your income bucket. How much of my TSP am I going to use for the purpose of income planning? And think about that for a second. If you have this TSP with $500,000 of money in there, right? Would you rather have that 500,000 be fully tax-free or fully taxable? Because that affects how much you pay in that income bucket, right? And how much you have to take out. And then this middle bucket is kind of like the conservative type bucket, or even the money that we're going to earmark for the purpose of doing things like Roth conversions, which we're going to talk about. And then you have your long-term savings buckets. But once again, when you start making decisions, you got to figure out how to start earmarking these dollars and how they perform certain things for you as you go. Okay. So let's talk about some of the advantages of TSP. TSP is a defined contribution plan. It's a 401k specifically built for federal employees. And this year, the regular contribution limit is 23,500. So what does that mean? That means that no matter what age you are, you can contribute up to $23,500 per year for the 2025 into your traditional or your Roth or a combination of the two. Now, I want to make sure I'm clear, because a lot of people get confused on this. It is not 23,500 in traditional, 23,500 in Roth. It is a cumulative amount of 23,500 completely, meaning you could have some Roth, you could have some traditional, but it's 23,500 total. Okay, no matter where you are or what combination you have, it's 23,500 total. That's important because I see a lot of people get that wrong. Now, if you are over the age of 50, you get a catch-up contribution of 7,500. So if you're over the age of 50, you could be putting in $31,000 a year, which is a lot of money to go into your TSP, which is a good thing. Now, this year, this is new, and a lot of people don't know this, but this year, they have what's called a special catch-up contribution for participants that are between the ages of 60 and 63. And that is a catch-up of 11,250. Now that's not on top of the 7,500. That's also including the 7,500. But that's an opportunity for a lot of you to be able to do that. And let me kind of give you some insider thing here. A lot of people that have taken the early retirement, whether it's VERA, VSIP, whatever you took, that are between the ages of 60 and 63 and are retiring no longer have to show up for their job anymore, right? Because they're technically retired but still receiving an income. But maybe they went and chose to go and get another job in the private sector. And all this money still coming in. I see a lot of federal employees utilizing that special contribution of 11,250 to really boost up TSP while you still have the opportunity before it completely goes away and you're completely retired. So again, I don't know if that's going to work for you, but I just want to give you some strategies that I'm seeing throughout this year with a lot of changes being made, obviously. Okay, so again, if you look down on the chart, you can see that up to if you use that special catch up, you could do $34,750 inside there. Now, here's the thing: why is this important when it's Roth versus traditional? Because this could be either or. You as a federal employee can participate 100% in Roth, 100% in traditional, or a combination of the two. Folks, this is unheard of in the private sector, by the way, and I'll talk more about that shortly, but you have some serious advantages here that you could take advantage of. Now, the matching contribution is something that everybody's going to be able to get, even if you don't participate. If you say, I don't want to put any money in my TSP, the government's automatically going to match 1% of your salary. Now, you can get up to 5% dollar for dollar. So that's a good thing, right? You'll be able to get matching contributions up to 5% of your annual salary. And again, you get the opportunity to contribute to both. Here's a question that I get often, though, is Ryan, if I think this Roth TSP thing is the greatest thing since sliced bread, and I go into it, do I still get the matching contributions in the Roth TSP? The answer to that question is yes, you still get matched. No, it does not go into the Roth TSP. It still goes in the traditional. So let me be clear. If you are in the Roth TSP, you will still get your matching contributions. However, they will be going into the traditional TSP. They are not matching in the Roth TSP as of today, subject to change. But as of today, the rules they are not going to be matching in there, okay? So it's a change that could come down the pipeline. And I only teach on things that are legitimately here now, not what could be coming down the pipeline, because we never know if it's going to happen or if it's going to change. Fair enough? So then so let's talk about the differences between traditional and Roth. Traditional TSP are pre-tax contributions that allow your money to go. So let me think about this for a second. You get your paycheck, and before you get your paycheck deposited into your bank account, money is taken and it's sent over to TSP, okay? Those are pre-tax contributions, meaning all the money that's in that traditional TSP is growing what's called tax deferred. Let's pay attention to that word deferred for a second, right? Because what are you doing? You are deferring your tax liabilities to a later date. Well, but Ryan, that's okay, because when I retire, I'm going to be making less money. Therefore, I'll be in a lower tax bracket. Well, when you've done this now for 15 years like I have, and you can start looking at statistics, right? 64% of our federal clients that we work with are in the same tax bracket when they retire as when they were working. Now, there's several factors that go into that, mainly because you guys have 3 sources of income, but that also is a silent killer we're going to talk about shortly. But that's a big deal. You got to think about that for a second, because again, every single penny that you take out of this traditional TSP is taxed at ordinary income tax. So whatever tax bracket you fall in on the federal side. Also, if you live in a state where you have state taxes, that will also be coming out of here as well. And remember, all matching contributions are going to go into this account. Okay. Now, on the complete opposite side, is this thing called a Roth TSP. And I gotta be honest with you, I think it's a phenomenal opportunity for a lot of you to do tax planning early on. And we call it the golden nugget because one of those things that if you take advantage of, you could really come out on the winning side in retirement. So what happens here? Think about the analogy I gave you before where you get your paycheck. This time you pay all the taxes on your paycheck and then you send the money over to the Roth TSP. See, that allows you the ability now to pay all the taxes up front. To be honest with you, I know it doesn't feel like it. We're in the lowest tax environment we've ever been in. Now is a phenomenal opportunity if you can take advantage of it to do so. So you have the ability to get a paycheck, pay all the taxes now when we're in the lowest tax environment, and then later, all of the money you put in there, all of the gains and interest are now a tax-free retirement when you retire. So if you had $400,000, I'm making up a number here, or if you had $400,000 in your TSP and the day you retired, as long as you've had it in there for 5 years, right? There's a disclaimer, you have to have it in there for 5 years. But let's say you've had it in there for 5 years and you take that $400,000 and you stick it in your pocket. You will not be taxed on that distribution, nor will that will affect your Social Security, nor will that affect your pension, right? So I'm not saying to do that. I'm giving you an example. Please do not do that because again, without talking to somebody first, there's a lot of things you got to make sure you consider. But I'm just giving you an example of now the flip side of that. If you went and you had $400,000 in your traditional TSP and you took that 400 grand, you stuck it in your pocket, the first thing that's going to happen is you're going to lose a third of it that moment because you're going to go to a very high tax bracket and you're going to lose the majority of it to taxes. Okay, so I'm not saying that you shouldn't do that or that's not a strategy. It depends on what you're trying to accomplish, but understand the tax liabilities that come with that. Okay, now again, here's an advantage with the Roth TSP. You have the ability, if you're over the age of 50, to do $31,000 into a Roth TSP. And by the way, there are no income restrictions with the Roth TSP. Why does that matter? Because if you go to XYZ financial company down the street and you say, hi, I'd like to open up a Roth IRA. They're going to say, great, how much money would you like to fund it with this year? And you say, well, I can put in $31,000 because I'm over the age of 50. I can put in $31,000 into my Roth TSP. I'd like to do that. Well, the first thing they're going to say is, sorry, the maximum amount you can put in is $8,000. Oh, and by the way, how much money do you make? Oh, I'm sorry, if you make over 200 something thousand dollars, then you're not going to qualify for the Roth because you make too much money. Huge advantage that you have here. Huge advantage. You have the ability to take advantage of something that's given to you that you can't get on the outside. That's why I think a lot of people need to take advantage of this, okay? But again, I wanna make sure I reiterate this. A Roth IRA, a Roth TSP, a Roth anything, in order to reap the tax benefits from the Roth, you have to have it in place and opened for 5 years minimally. If you do not, you can withdraw the principal from the Roth IRA or TSP, but you cannot touch the interest. If you do, you just create a taxable event for yourself, okay? So again, know the rules to make sure that you're getting the maximum out of this stuff. Okay, now, a word of caution on this TSP catch-up. This is important. I was teaching a workshop at a VA hospital, and a doctor came up to me, and this was September, and a doctor said, Ryan, I'm confused. I'm not getting any more matching contributions from my TSP, and I don't know why. When we sat down and ran his numbers and we looked at all the moving parts for him, we had figured out that he had completed his catch-up and maxed out his TSP by September. So what I want to give you a word of caution on is when you choose to do a catch-up or when you choose whatever to max out your TSP, do it on a 26 pay period basis because you get paid 26 times a year. So do it over the course of those 26 pay periods. Try not to really upfront fund it because what happens is you get matched on your contributions over a 26 pay period time frame, okay? He maxed out too early and stopped receiving his matching contributions. Make sure that you do it in a, in a way where you're getting 26 pay periods every time. Now, let's work the numbers. So you come to me and you say, Ryan, I want to get my numbers run because I think that I'd like to do this Roth thing. The first thing that I'm going to do, or somebody from MyFed University or whoever you get the opportunity to work with here, the first thing we're going to do is we're going to look at, are you single? Are you married? Okay, great. What's your salary? Let's take a look at that. Because if we work the numbers backwards, then we can determine if Roth TSP makes sense, if we can do it, or if we can't do it. Because there are scenarios where you cannot participate in Roth without really hurting yourself tax-wise while you're working. So let's look at the number. This example is a single employee making $70,000 a year as their gross salary. Now, everybody gets this gift from the IRS called the standard deduction. And if you're single this year, the standard deduction is $15,000. So what does that do? That brings their taxable income down to $55,000. So if you look at the brackets, you'll see that this individual falls into a 22% federal tax bracket, right? Because the 22% tax bracket for a single filer is 48,476 up to 103,350. Right, so clearly $55,000 is more than $48,000, so we're in a 22% tax bracket. But remember I told you, the traditional TSP contributions lower your tax liabilities while you are receiving an income. So here's an example. Your $55,000 taxable income minus your traditional TSP contributions now brought your total taxable income to $45,000. So what does that mean? That means that your TSP contributions took you from a 12% federal tax bracket down to a 22%, from a 22% federal tax bracket down to a 12% tax bracket. That's a 10% savings by using your traditional TSP to keep you in that lower tax bracket. But you say, but Ryan, wait a minute, that gets me down to 45,000, but the 22% tax bracket doesn't start until we're at 48,476. You're right. So what does that mean? That means that you could put in $7,000 into the traditional, take you from a 22 to a 12% tax bracket, and put $3,000 into the Roth TSP and get the best of all worlds. You're lowering your tax liabilities while you're working, but you are also building a tax-free retirement while you're working for your future. So this is an example of how you make these decisions, because a lot of times people come to us and we're running the reports and running the numbers. It really comes down to this, is understanding where do you fall and how is it going to affect you? Because look, what if the scenario was different? What if the situation was, there is no way for them to go into a Roth, or they're going to go up to a 22% tax bracket? Well, that would really affect somebody, because this is a situation where this individual could not go 100% Roth. If they do, they're putting themselves into a 22% tax bracket. So let's try to get the best of all worlds. There are also some scenarios where if you're so far in the 22% tax bracket that you can't get down to a 12, then you can go all Roth and still stay in the same tax bracket, right? There's a lot of different scenarios and situations, which is why, again, once I say at the very end of this workshop, if you want to get these numbers run so you know your specific options, make sure you put that down. Write us a book. Tell us exactly what you need so we know how to help you, because once this is over, we're going to reach out to everybody and answer your questions individually, okay? Now, I'm gonna spend some time here on this thing called a Roth conversion. And if you're taking notes, this would be probably the time where I would take the most notes, because for a lot of federal employees, and again, decades worth of experience here, is most federal employees have not taken full advantage of the Roth TSP. So I would probably be safe to say that the majority of you on this workshop right now, listening to this workshop, have the majority of your money in the traditional TSP. And that comes with its set of tax consequences, right? Because we all agreed that um, every single penny you take out of that TSP, if it's traditional, is fully taxable. And I think that if we had a show of hands of the 1,000+ people here, if I asked every one of you, in the next 10 years, do you think taxes are going to be lower or do you think they're going to be higher? I would probably imagine we would get a unanimous decision that taxes are going to be higher in the future. So with that said, why don't we take advantage of being able to start taking some of our traditional dollars and moving it over to a tax-free basis? Now, when you do that, you take traditional money and you move it over to a Roth IRA or a Roth TSP, which I'm explaining shortly. That's called a Roth conversion. And I really got to give you a word of caution here. Anybody that's going to do a Roth conversion, you really need to understand the tax consequences of this because there's a lot that goes into this. It's not something you say, hey, I'm going to take 100 grand and move it over from my traditional to the Roth, and because that could move you up one tax bracket, could move you up two tax brackets, right? You got to be really careful because that affects everything else in your world as well. But a Roth conversion is when you take traditional money and you convert that money over to a Roth TSP, which cannot be done yet, or a Roth IRA on the outside if you're going to do it in the private sector. Now, let me give you the differences between doing it internally versus doing it externally. I don't care which one you do. I just need you to understand your options, okay? You got to figure out what's best for you and your family. The Roth conversion, meaning if I'm going to take my traditional TSP money and I want to move it over to a Roth TSP, well, as of today, that cannot be done. TSP does not allow you to do it this year. However, starting next year, and again, I don't teach on things that are not in motion yet, but starting next year in January, they will have the option to do a Roth conversion inside of TSP. Now, some of you may be shouting for joy. Let me give you a word of caution there. And I'm going to give you the difference between doing this on the private sector versus doing it internally. From what we know and what we've been told, if you do a Roth conversion inside the TSP next year, you cannot withhold the tax on that transaction. So let me give you an example of what I mean. Let's say you say, Ryan, I'm going to take this $100,000 and I'm going to move it from my traditional TSP to my Roth TSP. And they allow you to do that. That's fine. And let's just pretend for conversation's sake, you should have withheld 20% for taxes, right? So that means that you should have withheld $20,000 in taxes. Well, unfortunately, inside TSP, doing a Roth conversion, they're not going to allow you to withhold the tax. So that means that that $20,000 is going to have to be paid out of pocket. And I know I just lost a lot of you there because you're going, well, why the heck would I do that? Do you have an extra $20,000 lying around? Probably not, right? And so that's a disadvantage. It's something that I don't foresee a lot of people taking advantage of because most people are not going to be able to afford to pay the tax out of pocket. Now, on the flip side of that, if you take your money and you open up an outside Roth IRA and you move money from the traditional to the Roth IRA on the outside, you can do that, and in that transaction you can withhold the tax most of the time. Okay, so that means that instead of you having to pay $20,000 out of pocket in this example, basically what's going to happen is 80,000 out of your 100,000 is going to make it over to that Roth IRA on the outside. So you have an opportunity to do that and not have to pay the tax out of pocket. That's something that the private sector offers that TSP does not inside. Again, you have to decide what makes the most sense if you're going to do this or not. Okay, so that's an important variable there. Now, the other thing to pay attention to is when you do this, you got to monitor your tax bracket situation, right? Because if you go from a traditional to a Roth, again, you're paying tax on that transaction. So when you do a Roth conversion, one of the things that you've got to really pay attention to is if I'm going to convert this money, what is my limits? And I'm going to show you shortly on one of the next few slides how we make those decisions, how you can too. But it's one of those things where, is this decision going to move me to the next tax bracket or not? Now, and I will say this, when you have $300,000 or more in the traditional IRA, 401k, TSP, that's when Roth conversions typically make the most sense. Below 300,000, it doesn't always make sense. I'm not saying don't do it, but most of the time the income that you're going to take is going to cover any real tax problems you could have later on. Now, why would you do this Roth conversion? Let me give you a few different reasons and examples. Number one, you want to have tax-free money in retirement, right? That's always a good thing. You want to go on a vacation, you want to buy a new house, you want to buy whatever, right? Then you can, would you rather take it from a tax-free account or a taxable account, right? So you can go buy that car that you want for $40,000, take it out of your Roth TSP or Roth IRA, and all that money is tax-free now. Great situation to be in. And all the growth of that account is also tax-free, right? That's number one. Number two, you pass away and all of your money is in traditional TSP or traditional IRAs or old 401ks, anything that's traditional, your family is responsible for the tax liabilities that come with that. So if you pass away and you are married, your spouse is going to inherit that tax problem and the tax liabilities on the money that he or she is going to withdraw down from. If you are leaving money to anybody other than a spouse, that family member, whether it's a child, brother, sister, mother, doesn't matter, they are subject to having to draw down all of your money in 10 years now. Used to have this thing called stretch IRA. That went away. They have 10 years now to draw down all that money. Think about the tax burden that could leave on somebody. On the flip side of that, if you pass away and you have your money in a Roth TSP or Roth IRA, your family or the beneficiaries will receive that money on a tax-free basis. So again, from an estate planning perspective, plays a really big role. Now, let me give you the number one reason why most people do Roth conversions when we're talking about tax planning. Obviously, those reasons are very important, but from a tax planning perspective, and I run a tax firm, so I'm going to give you where I see this the most. Okay, there is this thing called a required minimum distribution that a lot of you are going to fall subject to. Okay, and the required minimum distribution is when you turn 73 or 75, which for most of you are going to be the ages. Again, you may already be in RMD time, talk about for the majority of you listening. The IRS is going to knock on your door, and based on the amount of traditional dollars you have, non-Roth, but traditional, they're going to add all that up. Now, that could be in multiple accounts. You could have, maybe you worked in the private sector and you have an old 401k that's a traditional money, or maybe you rolled over something to a traditional IRA, and then you have this traditional TSP. Wherever your money is, traditional accounts, the IRS is going to add those accounts up, and they're going to come to you and they're going to say, hey, you have X amount of money in here. You need to take this amount out because we want our tax dollars. Essentially why they're doing it, right? And why is that important? Because imagine you are 73 years old, and for the last 13 years or 10 years of your retirement life, your annuity from the government has been really good, your Social Security is good, and maybe you need $1,000 a month extra from your TSP. So you're taking out $12,000 a year, and life is good, right? You don't need any more money, your TSP is still growing, you don't need it, whatever situation is. But then all of a sudden, the IRS knocks on your door and they say, hey, we see that you're taking $12,000 a year out. But because you have this amount of money in your TSP left, you need to start taking out $30,000 a year. What do you think that additional, call it $20,000 is going to do to your tax bracket? See, the required minimum distribution, or RMD is the acronym, is the silent killer of most people's retirement. We spend most of our time at our firm helping people unwind their traditional, moving it to Roth and doing those Roth conversions and tax planning. That's one of the top strategies that we implement at our firm. And I got to tell you, because of that, what I just told you, what if you could be proactive and go in and do those Roth conversions. And because remember, Roth IRAs are not subject to required minimum distributions. Only traditional ones are. So imagine if you are 63 years old and you have till 75 if we have to worry about these things, and you've got a 12-year horizon where you can start doing those Roth conversions and converting it and reducing what the IRS is going to force you to take. What a strategy that could be to implement. And that is why I've spent so much time on this, because for a lot of you, you're going to need to do this. I'm just being honest with you. You're going to need to do this if you really want to take advantage of the taxes, really minimize your tax liabilities long term and keep you in a lower tax bracket. This is going to be vital for a lot of you. Now, if you do not do this, and for example, if you do not take the required minimum distribution like you're supposed to, not only are you going to pay tax on the total amount you're supposed to be taken out, right? So 30,000 in my example, you're also going to be subject to a 25% tax penalty on top of that. So not only do you have to pay your taxes, but you're going to pay 25% penalty on the total amount that you're supposed to take out. That's a big hit. That's a big deal. You're responsible for setting this up, okay? You are responsible for making sure that this distribution comes out. So I want to make you aware of it because something that's a big piece of this. Now, again, what I would say is this, remember, I want to answer your questions. I want someone from our team to be able to answer your questions. A lot of you are going to have questions on this. When the survey pops up at the end of this workshop, if this is an area of concern, put down, please talk to me about RMDs. There's a report that we can run through our software that tells you exactly down to the penny how much your required minimum distribution would be based upon where your TSP or your assets are at that time. And this is where you get to be proactive and start making decisions now versus being reactive and have to try to figure this thing out later, right? So that report is so important as we go through here, because here's the thing. How do RMDs affect taxes? So we talked about that. It could bump you to a higher tax bracket. But what about the Social Security piece? Remember I showed you that 3 buckets of income? What if you were being forced to take out that $20,000 more than you need, and that was the one thing that moved your Social Security, that extra 20 grand took your Social Security from no tax up to 85% of your Social Security being taxable? What if that was the one thing that moved you to the higher tax bracket, and now you have to go back to your annuity payment and withhold more, which means you're getting less from your annuity than you were before, and now you're getting less from your Social Security because you're withholding tax, and now you're starting to, man, I got to take more money out of my TSP. Would you run out of money faster in that situation? I don't know, right? So that's a big piece of this. They are your silent partner, the IRS, in this deal, and you got to make sure that you have this taken care of and that you have the strategy in place, okay? Now, here's an example, excuse me. Here's an example of the software that we use. I really love this because it gives a great illustration of somebody. You can just kind of look over here on the right of your screen. This person, in 1 year, by doing a Roth conversion and started to bring their tax liabilities lower, saved $37,000 in less taxes paid. And here's another example of how you make these decisions. So this is a software that we have, and again, this software is out there, but this is the one that we use at our firm. And you can see on your screen here, this is a married couple. They're both age 65, and they want to do Roth conversions. And they wanted to max out the 22% tax bracket. And you can see over there that their conversion amount in 2025 was $108,000. So they could actually move $108,000 and still stay in the same tax bracket. Really important to know. So again, I'm not going to dive too deep in this, but these are things that you want to make sure you get access to and get help with, okay? Now, here's what a real RMD breakdown. This is an example, and pay attention to this because this is where a lot of you are going to fall into. This is an example of somebody who is 73 years old, has $500,000 in their TSP. This is what they would be forced to take out, as you can see on your screen, $19,607.84. But Ryan, I only need $10,000 for my TSP. I'm sorry, but you're still to take out the additional almost $10,000 you don't need. What does that do to your tax bracket? See, The Roth IRA, Roth is not subject to these required minimum distributions. It's why doing those conversions or taking advantage of Roth while you're working is so important, because it allows you to dodge a lot of these tax bombs that are out there that are coming for you if you don't pay attention to them. Okay. Now, putting it all together. So again, as you can see, as we kind of look at all these things in pieces, you have your pension, you have the TSP distribution, you have Social Security. And like I said, these are like puzzle pieces. They all have to work in harmony with each other. And that's why when you sit down, you get your numbers run, you get the pension projection report that we do for everybody. It's going to give you this illustration of where am I, what changes do I need to make, and how soon can I implement them, right? Because again, the younger you are, the easier it is for you to be proactive versus have to be reactive later on in your working career and in your life, okay? So be proactive and take advantage of it. Here are some things that you can do right away. Is if you saw anything that you could do to make changes from TSP, maybe it's doing the Roth if you want to go into it now that you have a little bit more of an understanding. Break down your real numbers. What are my real numbers? Do I have any debt? Do I have, what's my pension going to be? What's my TSP projection going to be? What are my RMD? What's my tax problems going to look like? Get the numbers ran, and hey, listen, get help if you need it. That's what our team is here for, to help out and answer any questions you have. Like I said, what we love the most is when the survey pops up at the end and you write us a book on all the things you need help with, right? Be specific, because the more specific you have, the easier it is for one of our team members to be able to answer your specific questions and not waste your time. We don't want to waste your time. We want to be able to get in touch with you, answer your questions that you have, and help you out in any way that we can. But the more detailed you are, the easier it's going to be. So we can run this report for you, and you know exactly to the penny what your pension is going to look like, what your Social Security is going to be, what your TSP projection is going to be. And then you can start looking at, hey, should I do Roth? Hey, should I do this conversion? You make those decisions when you know all your real numbers. So I want to give you a couple resources here before we wrap up. You can, if you have any specific questions, you can email us at info@myfeduniversity, or you can call their number is 919-706-1846. But again, the survey is going to pop up and somebody will get back to you as long as you fill out that survey and say, hey, yes, please give me a call. I'd like to get my numbers ran. I'd like to understand where I am and help me out. More than happy to. So with that, I want to say thank everybody for being on here. Hopefully this has been helpful, and we'll all talk to you soon. Take care. Bye-bye.